Welcome to this explainer. Today, we're unpacking a massive, multi-billion-dollar contradiction defining one of the most talked-about companies in global retail right now, PDD Holdings. We're looking at a business standing right on the precipice, mere days away from a pivotal second quarter 2026 earnings call that honestly has Wall Street totally fractured. Profit margins are under intense pressure, regulatory scrutinies are mounting, and yet, some of the world's most legendary investors are practically backing up the truck to buy in. It's a true paradox, and we're going to break it all down.
To really wrap our heads around the sheer scale of the company we're dissecting today, we got to start with this number, $126 billion. That's the approximate market cap of PDD Holdings right now. Headquartered in Shanghai, with executive offices now stretching all the way to Dublin, Ireland, this isn't just some regional player. It is an absolute titan of global retail, and it commands massive influence over how literally millions of people shop every single day.
Okay, let's dive into this. PDD Holdings operates two distinctly powerful engines. On one side, you have Pinduoduo, their domestic juggernaut. We're talking a social e-commerce giant in China, boasting a staggering 800 million-plus monthly active users. That is massive. And then, on the other side, you have the name you're probably seeing everywhere lately, Temu. This is their incredibly aggressive, fast-growing international marketplace that's just rapidly capturing the attention and wallets of shoppers all across North America and Europe. So they're essentially fighting a war on two massive fronts.
But here's the core mystery we really need to solve today. Despite this giant global footprint, the stock performance has been, well, incredibly challenging this year. As of August 21, 2026, the stock is trading right around $88. That means year-to-date, PDD shares are down roughly 20%. They took a sharp 25% dive in the second quarter alone, and sure, while they've recovered slightly since June, they're still deeply in the red for the year, trading way below their 52-week high of nearly 140.
Section 1. Revenue up, profits down.
That sharp compression in the stock price, it's really driven by a central contradiction. Revenue is going up, but profits are going down. Just look at what Wall Street is bracing for ahead of this upcoming earnings call. Analysts are actually projecting top-line revenue to climb significantly, jumping 16 to 19% year over year to hit roughly $17 billion. Honestly, that's fantastic top-line growth. But the catch is the net profit. It's expected to shrink from over 30 billion yuan last year down to 24.4 billion yuan. Earnings per share are forecasted to drop to around $2.73, which is down from $3.28 in the exact same quarter last year. So more money is coming in the door, but a lot less is staying in the bank.
So, why the profit squeeze? What on earth is eating up all that cash? Well, it really comes down to a two-step drain on their resources. First off, Temu's global expansion is incredibly expensive. PDD is pouring absolute fortunes into marketing, promotions, and shipping subsidies to aggressively win over buyers in the US and Europe. It's a high-cost strategy, and it's weighing heavily on short-term margins. Second, they're facing fierce domestic headwinds back in China. Deutsche Bank has noted that their fundamentals haven't actually bottomed out yet, pointing to domestic tax compliance issues and just intense competition from live streaming e-commerce platforms. You combine these two factors, and Citi analysts are expecting up to a 28% drop in adjusted net profit.
Section 2. Regulatory risks and headwinds.
These intersecting pressures are actively weighing on market sentiment right now, leaving Wall Street profoundly divided. The analyst ratings here are a picture of absolute polarization. On the bearish side, you've got Daiwa downgrading the stock to a hold with an $80 price target, alongside Barclays and BNP Paribas seeing it as an $89 stock. But then, look at the other end of the spectrum. CMB International is maintaining a buy rating with a target of $154.80, and Morgan Stanley sees it going to $129. You have top-tier analysts looking at the exact same company and coming to wildly different conclusions about its near-term survival and growth.
The pessimism from some analysts is grounded in some pretty compounding business risks. Over in Europe, the Commission has launched formal obstruction proceedings against Temu regarding foreign subsidies, which could trigger a massive fine of up to 1% of the global turnover. And back home, Deutsche Bank is flagging governance concerns, specifically highlighting a lack of shareholder returns since, well, PDD pays no dividends. Add in a sudden governance transition following the unfortunate passing of an independent director, and you've got some very tangible headwinds making institutional investors highly cautious.
Section 3. The smart money bet. Now, what's really interesting about this slide is how it perfectly pivots the narrative away from the fear, straight toward the major institutional investors who are actively buying the dip.
While some analysts are screaming to sell or hold because of those risks we just talked about, Some of the most successful investors on the planet are quietly taking the exact opposite side of the trade. We're seeing massive stock purchases by legendary billionaires, eagerly buying the dip. Duan Yongping, an early backer of Pinduoduo, increased his position by over 26%, adding 5.27 million shares. His fund now holds roughly $19.1 billion worth of PDD stock. And look at Li Lu over at Himalaya Capital. He increased his stake by a staggering 133.5%, scooping up 6.15 million shares at an average price of $92.32. PDD is now Himalaya Capital's third largest holding. These are not small, speculative bets, folks. These are massive votes of confidence.
So why are they buying? Well, it largely comes down to this number, 9.63x. That is PDD's current trailing price-to-earnings ratio. To put that into context, PDD's 5-year median is roughly 17.5. Paying just over 9 times earnings for a company with this kind of massive revenue growth, that is a severe compression. It indicates that the broader market is heavily discounting the stock right now.
And this perfectly sets up the bull case. According to the valuation metrics from Guru Focus, PDD is trading roughly 43.8% below its calculated intrinsic value of $158.24. They give the stock a GF score of 71 out of 100, citing a balanced combination of financial strength, profitability, and growth metrics. So the smart money bet is quite simple, really. They believe the market is severely overreacting to the short-term pain of global expansion costs, and in doing so, leaving the company's long-term global potential incredibly undervalued.
Plus, the bulls will definitely point out that PDD isn't just sitting back and letting these headwinds batter them. No way, they are on the offensive. They recently launched a fastest delivery by tomorrow service to directly attack quick commerce rivals like Me2One and JD.com. They are basically pulling a page right out of the Amazon playbook, pouring resources into AI logistics and smart ad software to really boost seller efficiency. And to top it all off, they're committing a massive 100 billion yuan over 3 years, specifically targeting their supply chain and first-party brand business. They are aggressively building out the infrastructure of a global empire.
Section 4. The upcoming catalyst.
All of this, the revenue growth, the profit squeeze, the regulatory fears, and those big smart money bets, it's all about to violently collide. Monday, August 24th, 2026. That is the moment of truth. That's when PDD Holdings will release its Q2 financials, followed by their morning conference call. This single event is going to test both the bear and the bull theories in real time. Investors aren't just looking for top-line revenue anymore, they're going to be hyper-focused on Temu's profitability margins, tracking exactly how much cash is still bleeding into global expansion and really seeking tangible progress on those massive AI and supply chain investments.
Which leaves us with the ultimate question as we head into earnings. Is the market wildly overreacting to the short-term pain of building a global marketplace, offering what could be a generational buying opportunity? Or is this profit squeeze just the beginning of a long, arduous battle against international regulators and domestic competitors? We're going to get our first major clue on August 24th. Thanks for joining me for this explainer, and be sure to keep a really close eye on those margin trends when the numbers finally drop.